Okay, folks, welcome back. This is our midweek review for August 14th, 2019. So I kind of want to talk a little bit about what I've said recently, and one of our members have taken things out of context, and I kind of want to help him and also aid anyone else in the confusion that may have arisen as a result of it. So I made recent comments about my view on the dollar index, and I gave a kind of like a percentage, which I hate always doing that, but I get a lot of questions sent to me, and the request is, what's my opinion about a specific pair right now? Because we predominantly stay with the Euro USD and the British Pound USD with the dollar index. I do not want to have the same problem I had with the first mentorship group, where everyone was trying to have it their own way. And I can't have my attention spread so thin that I can't focus. And that's exactly what happened in the first year. So I've elected to just stick to what I have been doing for years, which is just primarily focus on two pairs. Now, they may not fit your expectation. You may want to be an Aussie dollar trader. Okay, you may want to be a Kiwi or a Japanese yen trader. In that regard, I'm probably very frustrating for you. You do not need to have every pair. If you learn what I'm teaching you in the euro and the pound, all of it is easily transposed over to any other pair, and many times any other asset class. I know it's hard to grasp that if you're new, but it's the truth. So to help me be more efficient as an educator to you, and also to keep these videos from becoming 4-hour mini-series installments, I like to keep things exactly how I look at it on a day-by-day basis. So I think if you look at what I do with the euro and cable, it's sufficient. It provides the outline for the weekly objectives that I personally look for. So with that said, I gave a response to, like I do with most of my tweets, they are really answers to, or replies, blanket replies to a large block of similar emails. Okay, so when I go through emails, I go through them by the day. Okay, so when I get an email, I go by one calendar day. Everything that comes in that day, then I break down those emails. And a lot of them, it's because of whatever I said on Twitter, or because I've said something in a recent commentary in the mentorship. Invariably, someone or some folks, a small collection of you students, will ask me a very similar question. So to avoid the time that it requires me, because right now I got like 11,000 emails. Now, I don't know about you, but that's a lot of emails. Now, granted, there's a lot of those are payment notifications and things having to do with the mentorship enrollments, but they still have to be sorted. So I'm one person. I can only answer the technical side of the emails. All of the administrative payment stuff, I don't do anything with that. So, and enrollment as well. So my focus is primarily on looking at questions that come by way of email. Now, this is not an invitation for you guys to send me emails, because if you're in the mentorship, the number one rule is write down your question in your study journal. When you get to charter member, 99.9% of those questions are going to be answered in the content if you pay attention. But there may be a question that's really hard pressing for you, and you feel like you have to ask me. Be invited openly about that, because I don't want you to struggle. I don't want you to feel like I'm just pushing you aside. Okay, but I do want to remind you, 90% of what you're going to ask me, my response is going to be, it's going to be taught later in other lessons. So again, with all that preamble out of the way, one of the questions I got was, if I was kind of like forced to decide if I was bullish or bearish on the dollar index, where would I pick? So I said, I'm like 60% bullish long term still, because we're in the middle of a large range on the daily chart. Now, what does that mean? Does that mean that there's no potential setups that could be bearish for the dollar index? No, and it doesn't mean that there won't be really good setups when the dollar's bullish. It just means that from a long-term standpoint, and I believe this lesson will kind of like answer this for a lot of you, you can work within a long-term bias on both sides of the marketplace. And when you incorporate options, you can actually sell options in a market that is predisposed to go higher or lower long-term, and just write options and the market goes sideways in a range, and you can make money doing that when the market doesn't really move and still maintain a long-term bias, directional higher or lower. You have to have an understanding of what you're looking at with the respect of fractals. Okay, so a large long-term macro view starts here. You have to have and understand what the central banks are doing. This website is fxstreet.com, and if you do a Google search on fxstreet.com and world interest rates, it'll take you right to this website address and link. So what I want to show you here is the Federal Reserve, that's the U.S. current interest rate from our central bank. If you look at the European Central Bank, it's 0. We have the Bank of Japan, it's negative interest rate. New Zealand, it's 1%. Bank of Canada, 1.75%. Bank of England, 0.75%. And Australia, 1%. And Swiss, which we don't talk too much about, is a negative interest rate as well. So if you look at the interest rate, for instance, with the Australian dollar, it's 1%, and the Federal Reserve, which is a U.S. interest rate, on the central bank level, it's 2.25%. Money will seek yield. Okay, from a long-term macro stance, the way hedge fund managers utilize their equity base and invest it, investors are looking for return on their investment. So if a large fund were to want to invest in these two countries, how would they best play that? Which one has the higher interest rate? The Federal Reserve. That's the U.S. market. It's 1.25% more in interest than the 1% that the Australian Central Bank is offering at present time. If we translate that into a Forex pair, the Forex pair that groups these two currencies together, it would be Aussie dollar. Since Aussie dollar is the first currency in the pair name, and the interest rate is lower in Australia than it is in the US, that means this would be bearish. That would mean Aussie dollar should be bearish long term. If we go to a chart, okay, here's the Australian dollar, and here's where we've been going. So over a long period of time, the ebb and flow of this price chart has seen ups and downs. But look at the gravitational pull to lower prices in general. If we go back to our table here, it tells us the next time that the central bank will sit down and review whether or not it's going to raise, leave unchanged, or cut the interest rate of that country. It's September 3rd, 2019, which is coming up in a few weeks. Federal Reserve will also be meeting to whether or not it will raise, leave unchanged, or cut its interest rate on the 18th of September. All of these dates, everything that's set up by date here, these should be the same parameters until we get to around the 3rd of September. So basically the rest of this month, from a long-term macro stance, this would be bearish for Aussie dollar. Now, it does not mean that every single day it's going to go down. It does not mean that. The interbank price delivery algorithm will obviously have to move from discount to premium, discount to premium, discount to premium as it moves to these dates. Now, there's been times when the market has a huge turn before one of these, and they always try to say that, well, they've priced in the interest rate decision. And again, forget all that. Just know that I was leaning on this information right here. Which out of all the countries here has the highest interest rate? The Federal Reserve. That's the U.S. Central Bank. So from a long-term stance, doesn't it make sense to be more weighted on the buy side of the dollar than to be bearish? That's all I was saying. That was the information I derived that decision from, which I just said in a video. But it was taken out of context and used as a weapon for insult on Twitter. So I just want to remind you folks, I already threw someone out of this mentorship because they did that stuff in the forum and repeatedly was warned not to do it after I went in and cleaned up the posts. I don't care if you don't agree with everything I say. That's what you didn't pay to be in an argument or a debate with me. You're here to learn. I'm doing that. I'm teaching. You're not going to have everything line up perfectly for you always as a trader. You have to work within market conditions. And because of the market conditions that's in the dollar index right now, if we go over to a chart here, this is a trading view. And this is the cash market for the dollar index. And if we look at how this chart looks compared to the chart on the Ava trade demo, Ava trades using the futures contract. Okay, this is very close to September's delivery contract for 2019. This low here did not come down and close in the volume imbalance, and we didn't even get down to the equilibrium price point of this dealing range, which I said it can come down to that, but it would be better if it didn't do that. But if it trades below that, then I would be bearish dollar. I gave you those things as a context that would change my near-term stance on the underlying fundamentals that I just outlined relative to the interest rates. Now, think about it. We were trading around in here. And so if it came down and went below the equilibrium of the dealing range here, if it broke that, think about how much time would be left until we got to those interest rate deadlines again that I showed on FX Street's website. You don't have to get the information from FXStreet.com. It's lots of information. You can get it from CNBC. It's relatively easy to get, but that information is only providing someone with the insights of utilizing the disparity between the two interest rates. That's how we get the imbalances and rebalancing in the foreign exchange market on a long-term basis. But if we broke this equilibrium price point, there wouldn't be enough time, in my opinion, this is why I said what I said regarding this level. If we broke that, I don't think there was going to be enough time between this level breaking and then the interest rate announcements on the Federal Reserve in the 18th of September. So I just viewed that as a catalyst that would change my stance on near-term bullishness on the dollar. Now, long-term bullishness, it still remains bullish because of the differential between the interest rates. That is a huge economic driver for large flows coming into or out of currencies. If we go back to this is the cash. You can see that the cash does close its volume imbalance and trades down to the consequent encroachment and trades down to the equilibrium price point between the dealing range high and low. And we had since then moved higher. My opinion is we still are inside the range. This is just one move outside of the range that we were looking for back with these equal highs. We want to see that run. We saw that, okay? But we moved back inside the range. When it does this and goes back below these equal highs, we're inside the range. I require price to want to show me a willingness to get out of here and continuously move higher. What are we looking for? I want to see it go above this fair value gap. It needs to go above that and breach the rejection block. And if it does that, then I think that we have a real low in here that, again, at that equilibrium price point. If it breaks below that, all bets are off. I think that they probably have made the decision on an interest rate basis, and we'll probably see lower prices on the dollar index if we take this low out. But until that happens, long-term bullishness still is in play for me. That's what I said by saying that. The long-term macro bullish trend, if you want to call it that, go back and listen to the video. Every time I said it, okay, it was a macro, long-term bullish. It doesn't mean I can't sell short currency that would see the dollar going lower. I'm a day trader, and I can take one shot, one kill. Still, in those instances, now, is it as high probability as going long in situations like shorting foreign currency, like Aussie dollar? No, it's not as high, but it still can be a high odds, low resistance liquidity run if it's framed in the proper context and still be against long-term macro trend. I don't know what makes that so hard to grasp, because if you look at, again, go back and see, we have the price chart here on Aussie dollar. Here. Look how many price swings we had in there. Even though that the macroeconomic data says that those interest rates are so different that Aussie dollar should have very easy, low resistance liquidity runs on the low end. In other words, all lows should have no problem being ran out. And just look at all the lows. They get taken out relatively easy. Every time a high gets taken out, generally that's a stop run. It picks up more liquidity to go short at a later time. That's all I'm getting at when I say I have a long-term bias on the dollar. And it was still 60% bullish. Why did I say 60% and why not 75? Or why didn't I say 80%? It's just a number that I felt from an emotional response to the necessity that this member needed to know this. Okay, and I told him, I said, long term, I don't try to pick the tops and I don't try to pick the bottoms. I stick with it for a long time until it completely disintegrates and I don't have any faith in following it anymore. I outlined that with the dollar index here. Okay, so if we break this low, I'm going to be really reluctant to be long-term bullish on dollar if we take that low out. And it's as simple as I can make it, Mike. All right, so with that, let's go back over to the interest rate market here. So if we look at, for instance, the Bank of England, 0.75% versus 2.25%. British pound, dollar. What is a pair in Forex that we trade that has those two countries' currencies? Pound, dollar. So which one has the higher interest rate? 2.25% versus 0.75%. Obviously, the U.S. market has the higher interest rate. So in relationship to that fundamental long-term differential on the interest rate, large institutional funds will be what on pound dollar? Bearish or bullish? Bearish, because Bank of England, it's not paying out as high as interest rate. So investors are not going to see a lot of flows coming into this currency as a buy. They're going to be selling their pounds and buying dollars. So what does that mean for the currency itself, pound dollar? It's going to be weak. It's going to go lower. Well, if we go over to the pound dollar, this is what we've been seeing. We've been calling this. We've been looking for this to continue. Okay, we had all these objectives. We're looking for these equal lows. All that is based on what I just gave you, and all this is taught in mentorship. So again, I cannot cram every lesson that you learn in the 12 months core content into every single video. There's times and places for me to utilize it. The only reason why I'm spending this much time in it is because I'm offended by one of the members. And I'm highly irritated that this individual would be so ignorant. It offends me. So I want you to know that I'm not guessing about any of these things. I'm utilizing tools that I teach actively in this mentorship. So again, I'm not trying to win your opinion or approval of me as a person, but you're not going to deny the things that I'm teaching you are the catalyst for me to come up with the decisions or why I talk about what I talk about and why generally it's 90% accurate here. Period. Go back and do all, you want to do all these, scorecards, do the whole thing. Don't just pick out one thing where I talk about a currency pair, again, because someone asked me what my opinion was about dollar CAD. At the time, I felt that it was heavy. Now, did I break it down to a trade where I'm going to buy here, sell here, it's going to go here? No, these are all suggestions to look at and study it. But look at what I did for gold. Look what I did for the euro dollar. Highly specific, and it came to fruition. So again, I get it. Some of you are frustrated. Maybe you took the dollar CAD trade, okay, on something, and you want to put the blame on me. The number one rule in trading is it's all your fault, not mine. It's your fault. I don't put you in these trades. We're in a demo all the time. That's why you signed the agreement, that it's all taught by demo. Because if you do things wrong and you hurt yourself financially, there's no recourse that you can take against me. That's why it's set up that way. Because I know there's going to be mentally unstable people coming into this. And they're going to look for every aspect of a way of externally placing the responsibility out of their own hands and placing it in mine or someone else's. And you can't do that with a demo account. That's the number one reason why I teach in a demo account, for my protection. Period. So, again, I'm clean slating. Okay, I'm letting you know, this is how I come up with these ideas. It's the stuff that I teach you. Now, with that said, I also got another question by another member, another charter member from the 2017 group. And the question was pertaining to a chart similar to this that they saw on social media. And I'm going to give you my idea about it. Number one, based on what I just said earlier in the video, long-term bullishness on dollar. With that said, look what we have here. We have the orange line here represents the 10-year yield on the U.S. government bond, or basically the 10-year note, and the 10-year bond rate on the German government bond, 10-year. Notice the high here on the German bond and this high. It's lower. At the same time, the U.S. bond was able to climb higher. Both of them are dropping, but look at the widening between the two. Okay, there's a lot of movement on the downside in the German bond. So they're spreading open there. There's a widening. Well, that's also complementary to what I just outlined relative to the differential between the two countries. Okay, so we have the European Central Bank, ECB, interest rate is 0. Federal Reserve, 2.25. Is that inciting buying on euro or selling euro? Selling. Now, go back. Let's go back and look at the chart again for euro. All right, zoom in. All right, so I was looking for these equal highs that you ran, because if it gets up in here, I would like to be short. I wanted to see if I can get up in here and run that as a high. So far, we've proven the last 2 days that it has been unwilling to get up there. Okay, fine. Big deal. So what does that mean? We have a little bit of an imbalance still in here. How we trade after closing this in, if we hit this and rally, you're probably saying, where's the order block in here? Well, it's the main threshold, this down closed candle is what I'm eyeing up, and also this BISI. So a buy side imbalance, sell side inefficiency, we can come down and hit that. If we trade below this, if we trade below, I'm just going to call 111 big figure, even though it's 111, 113. If we trade below 111, okay, we're going to go deeper into that weekly BISI that needed to be closed in a little bit more, I think, that we didn't do on the initial run here. So I think we'll see that. That's what long-term, okay, from a long-term stance. Let me zoom in a little better. Right in here, and I'll highlight that. There you are. So we have the BISI here. We didn't come all the way down into it, so I think we'll make another run in here, but then we had all of this volume imbalance that needs to be, in my opinion, cleared up. This bullish order block, think the mean threshold, which is close to this level here. So the close 107 and a quarter, 107.50, 107.30 is the potential run that it could see. And again, this is long term. Does not mean every single day of the week Every Tuesday is going to be a high of the week. Every Wednesday is a sell. It doesn't mean all that. It does not mean that. There has to be other justifying factors involved to decide whether or not you're going to be going short. But from a long-term stance, these two things, okay, are very instrumental in terms of why it needs to rebalance and go lower. Also, if we see the interest rate market, as we mentioned on that website, remain the same, that means the fundamental long-term macro position stays the same. That is bearish euro dollar. Okay, it's as simple as that. Now, let me go back to that chart because I don't think I mentioned everything I wanted to say about it. Okay, here it is. This is Bloomberg.com/quote/GDB. Again, it's GDBR10:IND. Okay, if you put that in your browser, you'll get the chart without the overlay of the 10-year bond on the U.S. market. And all you have to do is over here, it'll say compare, where it says this. This won't be here. It'll say compare with the little magnifying glass. Put this in that box, USGG10YR, and then it'll pop up down here as like a choice. Click it, and it'll populate the chart with this overlay. Okay. So, and again, I teach all this stuff, so it's not like it's alien to you. Nonetheless, you can see the divergence between the two. This is around November. Okay, November. Well, that's October. Here's November. Yeah, November. So you can see the divergence here, higher, lower, and the longer term turn. These are long-term turning points. Okay, it takes a long time for a market structure to shift and get in sync with these types of moves. Now think November. Go back to the chart. Let's go to the daily. Zoom in a little bit. So here's November. Okay, or they're close thereabouts. We ran up, but then high, sell off, high, sell off, high, sell off, high, sell off. Pumps above, clears equal highs, nice sell, runs one more time, mean threshold, sells off. Consolidation, really tight small ranges, and then finally breaks down into an area we called for that weekly BISI. Now, it didn't completely close in, as you can see, that blue shaded area didn't quite get down there. If we run above this high on August 6th, same thing I mentioned relative to the dollar index. And now I'm not bearish on euro. I will be neutral to slightly bullish. Now, the reason why? Because they're still in large range. My gut tells me, okay, and this is just experience speaking here, nothing in the chart yet. I just feel like they're going to do something in the euro this year before the end of the year, and they're going to really send it up higher and jam everybody because the funds are really making money going short. So with that said, we have to still stick with the long-term macro view that the fundamentals state that there's more flows coming into dollars and out of euro. So translate that into a tradable idea. Euro is weaker, dollar is stronger. For the pair, that means the euro should drop against the dollar. Okay, that's just applying very, very long-term macro fundamental basis relative to the interest rate market and the differential. Okay, so with all that said, now let's go back into the regular market review rather. All right, so we have the futures September contract of the dollar index, which is being shown here in Ava's demo account. We have a volume imbalance here, small little volume imbalance in there as well. If we get above that and get above the rejection block, then I think that we have turned the corner. This low will stay intact going into, probably November. Now, I know I just said, and you need to put that down in your notes because I just gave you a very specific thing. If we take out the rejection block, we probably have made a low going into November. So that means that we can stick with the long-term bullishness again, unless it trades below this low. If it trades below this low, then it's over. Okay, because if it trades below this low here, that means on the cash market for the dollar index, that means it would be below this low. which is, again, the mean of this high and this low. The equilibrium has been tagged, volume imbalance rebalanced, mean threshold of the bullish order block, and then we've seen this reaction here. What I'm concerned about is that we're going back up here, just closing in the fair value gap, trading the mean threshold with the bearish order block, and then we roll over. That's what I'm concerned about, because this could have been the instigation of them trapping buyers, and then we took it back lower, and this is them maybe like dangling that carrot, like, okay, come on, it's going to run higher, which everything fundamentally from a carry trade standpoint leans heavily on this thing going higher. I personally just don't trust it. That's the reason why I'm not 80-90% bullish long term on the dollar index, because my experience tells me that this should have we should have already left this range. We haven't. So I'm highly suspect of what we're setting up in here. And my gut tells me, even though I don't try to pick the tops, I'm just very apprehensive about going in here and just indiscriminately being long dollar and shorting everything else. So that's what you're paying for. You want to know what my internal dialogue is. You want to lean on my 27 years experience. That's what I'm talking to you about. That's what I'm saying. That I don't have time. Okay, I really do not have time to break down to the nth degree of what decision-making process I go through, because it's already explained in the mentorship. Okay, so again, if you've gone through the mentorship twice, you haven't gone through it enough. If you haven't gone through it 5 times, you have not gone through it enough. You need to go through it, cycle through it until you know exactly what I'm going to say, why I'm saying it, because it's explained elsewhere in the mentorship. It's a lot of content, folks. You cannot take 27 years, compress it into 12 months, and then however long you watch the videos, I guarantee you, most of you weren't even really paying attention. You were distracted because you have a spouse, you have children, you have jobs, work, health problems, holidays. The world around you is a distraction. And you had hundreds of hours and thousands of hours, really, if you consider what I put out in terms of these reviews, old content, and the reviews that I did in the first year, plus the core content lessons. And that's just a little piece. And that's why I'm telling you, you need to just relax. Enjoy the process. Don't rush, because you're not going to catch up by just watching the video. That's what your mind's telling you. I mean, just hurry up and go through the videos real quick, and then I'll get caught up. No, you're not. You're not. The proof is the people in 2017 are still confused about things that are very clearly laid out in the core content. But because they're rushing, they're trying to cherry pick what they like, and the things that they don't like, they're not spending any time with it, finding out why they don't like it, because there's a barrier there. If you don't love everything about the mentorship, there's a problem, because there's opportunities for you to go back in and say, okay, I understand exactly what he means when he says that. Now, whether you choose to use that in your model every single day and week when you're trading, there's a time and place for everything. But none of the things I taught you were wasted. There's no fluff, zero fluff. Okay, I had comments shared on Forex Peace Army. Some goober says that the IPTA data ranges are fluff. Man, you don't even know what I'm going to teach you about it. Okay, again, these people think that they know everything because they watch the video. They're fools. They're absolute fools. So again, everything that I give you, there are opportunities for you to dig in for your own. Go back in there and find out why I said it. Everything I'm talking about, if I say long-term, go back and think about what are the things I talked about for long-term trading. Number one, the highest thing is interest rates. Interest rate triads. Then you have to look at COT data, seasonal tendencies. All of those things coupled with interest rate differentials, that's your whole macro portfolio. That's it. That's nothing else you need to do. There's no other thing for long-term macro analysis. That's it. Well, I guess if you want to utilize intermarket analysis, I didn't think I'd say that. But that's it. That's long-term macro trading or analysis. And the things I teach you, bank traders don't even do this. Okay? They don't put this stuff together like I just outlined. They don't do it because they don't have the technical aspects of IPTA behind them. So there's really no reason for it. Now, obviously, everyone and their brother knows what a carry trade is and interest rate differentials. But again, just like commitment of traders and net trader position charts, they think they know it and they go in and trade and they lose. So they walk away thinking, well, it's useless information. It's not useless. In the right hands, You have to apply it with the right conditions. And because the market for the dollar index is in a range-bound consolidation, that means other pairs, other markets can trade freely, just like euro pound is allowed to move higher by holding euro in consolidation and dropping cable, or rallying euro dollar and holding cable in consolidation. Then euro pound will trade accordingly and respectively. They're holding dollar right now. If you can't see that, I can't make it any plainer than it is. It's not left its range outside of this little run here. To me, I think they trapped people. Now, I'm going to be honest. In my head, and I don't want to do this because I know invariably you are going to say, okay, he's picking a top. I'm not. I'm just telling you what makes me very reluctant in trusting this as a buy right now. Because I think that we ran above these equal highs, trapped breakout artists. And we returned back inside the range. Yes, we went down to a logical price point where the equilibrium in this dealing range we talked about in advance. Go back and it's in the video. We traded off of it. It's reacted. But I need to see what? I need to see premium arrays be broken. That's how we get back in line with high probability order flow. Fair value gap, if it fills and starts to drop, well, that's not good. Not for bullishness. No, it's not. If we trade through the rejection block, which is the highest up close candle here, we trade through that, that's good. That means we can really have a lot of confidence about that low then. Doesn't mean you can't lose, and doesn't mean you're going to have a 100% strike rate and everything's going down in foreign currency and dollar's going to go up. It just means, and from a probability standpoint and using institutional order flow, that's how I break it down and provide myself the means of trusting it. Now, I don't know about you, but I paid a lot of money, and I've been in a lot of people's things throughout the last 27 years, okay? No one explains it like I just did. No one takes the time to do that. No one explains it in detail and all of a sudden has a clear picture as to why I'm telling you what I'm telling you. But now think about it. I haven't even gotten into this week's midweek video of what I want to talk about because I have to go through all this. Now, you're probably thinking, well, I'm glad this guy said all this because now look what I got to learn. You would have learned it anyway. It's in the core content. But it's in places that it's strategically located in the process of where its importance lies. And you're not going to retain everything I just told you. You just got your gears turning, especially if you're new, less than month 5 in the mentorship. And maybe some of this went right over your head. You're like, whoa, man, I had to spend it. This is going way too fast. It's too much information overload. It's all explained. But you can't try to assume because I give you a remark about something. And I don't want to sit here and fill the videos up or my tweets and say, this is a response to so-and-so and this is a response, because I don't have time for that. I don't have a lot of time. My time is consumed with managing this. And I read a couple posts in the forum. You know, instead of doing other things I'm doing, I should be spending more time in the videos. Man, I spend 1,000 hours a month, okay, managing this. And all of you seem to think that it's just you in the mentorship. It's not. There's thousands of you here. And I don't have enough time to do what I need to do as a husband, as a father, as my own free time. Like, I need time to unwind. And I can't constantly keep going. I gave you a ton of information and a lot of resources, and you still have tons of things you need to be looking at that's already been supplied to you. You don't know everything. Stop thinking that you mastered everything in the mentorship, because you have not. You have not. Period. You need to go back and study what you got. And every week, you get 2 installments from me, and charter members get another lesson every month. If I go any faster than that, it will just completely inundate you with information and you won't learn anything. I killed the first group. I threw everything at them way too fast. And in fact, I wish I would have spread it out longer. And I would have probably lost even more. And so what? I don't care. I'm already loaded. I don't need their money. I don't need your money. But I need you to focus, because you make this harder than it has to be and make these videos a lot more problematic for you as a student, because you're trying to judge without understanding why I'm saying it, when I don't have the time to go through every single video like this, because invariably it's time consuming, number 1. 2, it touches on topics that lessons that lower month students haven't gotten into. And I know what's going to happen. I'm going to get 1,500 emails asking all about what I said in this video. Don't ask me anything about this video. Everything that I've mentioned so far in this video is taught in the core content. So don't ask me. I'm going to say it's taught later on. Most of you, especially the new folks that are coming in, are not being very patient right now. And that's normal. You're excited. But you have to write down your questions and expect that the content itself will answer them for you. When you're done going through the week, you only have 2 videos for that week. Go through them, write your notes, and then refer back to your study journal and see if I did not answer those questions you had written down. Some of you are going to ask, well, what do I do with the London close kill zone if I'm in a trending market? Does it do anything? Why does he keep saying in long-term trending moves and swing trading, the London close kill zone has certain characteristics to it? Okay, well then you write down, why does ICT think that the London close kill zone is impactful or salient to long-term swing trading? And then when you get into the swing trading portion of the video, other parts will fit together. And then when you hear me talk about that specific kill zone again, it'll all start to gel. But even if that doesn't happen, once you're a charter member, you'll be able to converse with other members in the group on the forum. You do not get privileges to post to the forum because there's so many of you. I cannot moderate, and the folks I have helping me, we can't moderate as many of you coming in if you're first month students, and you're just going to come in, you're going to ask 50,000 questions, you're going to talk about things that's going to be very distracting, and it's going to be like baby pips, and I'm not running baby pips, okay? I need everyone to have a core understanding of vocabulary that's been derived from 12 months of core content and weekly, 2 videos per week of talking about what's going on. You're forced to get in the same mindset as me. It's a hive mentality here. That's the only way I can manage a group as large as you all. Now, it does not mean that you're brainwashed. Okay? You're all welcome to have your interpretations about price. But in terms of speaking and asking questions and engaging other students and me, then it's much more efficient for me to answer your questions in the very short amount of time that I send them, because my answers to emails are just like sending me a text message. If if someone sends you a text message about a question or whatever, you're not going in there and typing out a paragraph, 1,500 words and stuff. You're getting right to the answer, and that's it. And that's how I respond. Sometimes new members are put off by that because they think I'm just not interested in what they're doing. I'm giving you your answer. But I have 11,000 emails. And there's some of you, like we had recently a member, I don't care how busy you are, she tells me. Listen, I don't care that I'm making you that angry, because I'm trying to do as best as I possibly can, humanly possible, to provide you all with understanding and learning, and you can't find it anywhere else. And if that doesn't make you happy or doesn't make you have the resolve to stay with it, then see you later. I'm not going to twist your arm to stay here, but I'm not going to be talked to rudely. I'm not going to be disrespected because I've already thrown one guy out because of that. So there you go. I'm off my soapbox, and you probably learned something from all of it anyway. So, all right, let's go back into what I'm saying. I think that I'm interested in where we go on the upside on the dollar, because we were unwilling to get down into here on the futures contract of the dollar. But again, cash market, we went down into these levels respectively. The translation to that for foreign currency, again, we could see a continuation and a roll into this low. So liquidity resting below here. It pumped it up after coming into this area of liquidity, rebounced about 90% of that range, and then sent it up higher. Really, I wasn't happy with this. I would have rather really liked to see it get above these equal highs. To me, that would have been so perfect. It would have been signature move, really easy to get short in there, and then wait for that move to run on these lows here. That's what I would have rather seen. It didn't do it. It's been very fickle, and that's fine. If we look at the lower time frame, this is what I got going on. I shared this on Twitter. I said that we would be running to the rejection block. We were pausing in here, and we ran up and cleared the rejection block. And that pretty much capped the week so far on euro dollar. I was able to take 50 pips out of that from here and here. I'm sorry, from here and here. and then we made one more attempt to rally up, and then gave up the ghost and went lower. Nothing really in here to speak of that is all that terribly exciting. We have a little fair value gap in here, and we've since punched through that. I like this imbalance here. That's the next level to look at. So again, it's at 111.10, 111 big figure. If we get below 111, then man, it's going to get really interesting. I did on Twitter share these equal highs. If we could have pumped up a little bit higher and ran above the rejection block on a much more pronounced run for liquidity, I like these equal highs. If you look at the chart, it had like a little hello and a smiley face and trying to draw your attention. I like that area. It didn't get up there. So my initial tweet, which was running to the rejection block, that's all we saw happen for the week. So again, rolling into that, pretty much priced in the weekly high, all liquidity resting below these relative equal lows, and the small little fair value gap that remains between the low here and the, I think, to a 15-minute time frame. A little bit cleaner, you can see it that way. Liquidity pool, fair value gap. And this is where we're at. Now it might need to come back up and rebalance because it's getting a little spiky in here. So they may want to send it up a little bit into a premium again one more time, at least on a lower time frame, 15-minute chart. And then maybe one more time, send it lower. I don't really like where we're at here, so if you're not already in it, don't do anything yet. Demand that it trades higher first if you want to sell short on your demo and practice that. Pound dollar on a 15-minute time frame, it's sitting sideways here. If you go out to a daily chart, this is what I was talking about on Twitter. I said when we were trading up into the fair value gap on a daily chart, we had a small little fair value gap. We pumped up into that. I said, okay, start paying attention to it. Being short in here on a swing trade basis, I have a swing trade on right in here as it came into filling in this gap. I wanted about midpoint of it. And I'm holding on to it with a stop right above this here. Now you're probably saying, that's a huge stop. It's a swing trade. So I'm not trying to force a 30 pip stop loss inside of a swing trade. It's all relative. So what am I looking for? I'm looking for cable, again, to run these lows, and disregarding that wick here, I think it could go lower if we get that run on the dollar. So yeah, that's that. On a 15-minute time frame drop down, it's really sloppy. I want to see it just break loose and go lower. It just feels like everything has been sending it up into a premium so they could sell it off. So accumulating more shorts, accumulating more shorts, accumulating more shorts, and just hold it in consolidation. And finally, if the dollar will probably be the catalyst, if we do see it rally, we'll probably see cable run as a response to that. Last bit of business here. Well, actually it's not, because I'll talk about CAD in a second. Here's gold. So I gave you guys the unrealized dealing range inside the SIBI, the sell side imbalance, buy side inefficiency on the weekly chart of gold. That's this low to this high. That's that weekly SIBI. And we divided it, okay, in equal portions. And this is grading for your notes. Okay, so the price swing, we anticipate going up into this range. We start grading the levels in which PD arrays should form. Now these levels have not changed since I showed you in the markup when I produced it. When we get up in that last portion of the grading on the price swing, this is terminus. It does not need to get to terminus. As you see here, it went halfway, stopped dead point between these two price levels, and then we had that big drop lower. This is also at the same time the dollar index found some willingness to want to go higher. If we go into the 13th of this week and zoom out, here's that low. So everything we see on the dollar is going to be a mirror image on gold. So I'm watching gold. If we start to see this thing start to break lower, then really that is extremely bullish for dollar, because the long-term macro I outlined in the first 40 minutes of this video is the reasons why dollar is bullish long term. Okay, But now on the near term, if we see gold dropping, that's also intermarket analysis, providing us one more short-term catalyst to support a bullish dollar. So then we have two time frames working for us. We have the lower time frame, near term, being bullish because of gold wanting to go lower, and if it does drop lower, that's going to send like rocket fuel to the dollar index, and the dollar will rally. So I'm watching gold, and this is the only reason why I'm still talking about gold, because in this instance, to me, it's done. But now I'm only utilizing it for a analysis. Like I use the dollar index for a barometer for foreign currency. I want to see if gold has a willingness to want to go lower. It certainly wants to return back to a premium, which it has done. I mean, if we look at the range that it's created here, here's the 50% or equilibrium. Now we moved into a premium. So it's, to me, very important to watch it from this point on to see if we continuously erode and go lower. If it does, again, that's very easy telling confirmation for dollar index being bullish near term. So again, coupling that with the long-term perspective on dollar being bullish relative to the interest rate differential, you have like a really loaded deal, okay? Or as Larry Williams would call it, a lead pipe cinch deal. And I'll leave it up to you whether or not you find that of any value. And a last bit of business, officially. This was my response to the member that really kind of instigated this whole thing. And Mike, I just wanted to remind you, okay, I'm not going to respond to any other future thing like this because I'm spending way too much time on you. And I'm not going to let you hijack the mentorship, and you're not going to hijack my attention. So I'm only doing this because a lot of people follow me on Twitter, and I don't want anything taken out of context there and not left answered with the right amount of evidence. And I think I've done that for you here. So we have a fair value gap here on the dollar CAD. Now think about what I said relative to the interest rate market. What was the interest rate differential between the two currencies here? Okay, we have Bank of Canada, 1 3/4. Federal Reserve, the U.S. market is 2 1/4. Where the market participants wanting more likely to put their money, where are they going to get the better yield? They're going to buy dollars and sell loonies. So they don't want the Canadian dollar. They're going to sell Canadian dollar and buy dollars because the differential is 50% better by buying dollars versus the Canadian dollar. So from a fundamental standpoint, if we take that information and transfer that into a currency pair, it's dollar CAD. So if we are stronger dollar, weaker Canadian relative to the differential, and again, this is a long-term macro view. If we can couple that with short-term technicals, then we have a nice bullish bias. But you still can trade short in that environment. And I did it for you here. Right there. Now, I said, I'm going to go to a daily chart just for a moment. All right, I told you all in the video, and I'm going to do this right now, live again in the recording. Live in the recording, how about that? This down close candle right here, I put my line right on, that's low. Okay, so what's the low? 132.61 and 4 pipettes. All right, it's that. 132.61 and 4 pipettes. Okay, there's your black line. That's the level I said, watch this level here. All right, so that's our key higher time frame level. If we drop down into an hourly chart and zoom out a little bit. All right, so here's your price run here. It runs up and hits it the first time here on the 2nd of August. Okay, I said at the time, I said it looks kind of heavy, and we'll see what happens. Now, I'm looking at a pair that a member had asked me what my personal opinion was at the moment ahead of that recording on the 3rd of August. What was my opinion of it? It looked heavy. Now, that analysis was contrary to the long-term macro analysis that I just outlined for you here. It does not matter because I took no trade there. There's nothing on this pair, just because it hit that level, it has to do something for me. It has to create an opportunity where it's obvious, it's clean, it shows a willingness to run it. This right here, this little hit right here, it's too shallow. That's a daily level. I want to see them really work that level. Well, we get it here, and it breaks down below it. We get a punch above it here, and we try to trade lower, fill in the fair value gap, and then we pump it up one more time. I did not see this trade. Okay, I did not see this trade until we saw the rejection occur already in this fair value gap that's on a lower time frame, which I'll drop back down in. But my analysis concepts kicked in because of the buy side liquidity pool here. We ran above that fair value gap, and then I felt confident that we'd run this level here, even though it's against the long-term macro analysis. I'm not limited by that. I tell you all in the core content to utilize the long-term to build the confidence. You'll get to be able to do these types of moves, and I'll drop down to the lower time frame again. You'll get there. I didn't see it here. I saw it when we got down into the breaker here as it was trading into it live. Watch what happens when we go into a 5-minute chart. Zoom in. One more time. Can't go any more than that. This candle here, okay, it had opened, it was trading back up into the breaker. Mean threshold of the bearish breaker. As it traded there, that's exactly when I entered. Breaker. Liquidity pool, liquidity pool, liquidity pool, liquidity pool, liquidity pool, rejection block. Right here, lowest down close. And every relative equal low, relative equal low, relative equal low. Every point at which I exited and took partials was relative to these price points. Here, so I was pairing liquidity. Sellers, okay, I'm buying back some of my short that I put in here. I bought some back below the Asian range. I bought some back below the liquidity pool. I bought some back below the liquidity pool. I bought more below the rejection block. I don't care about that last little bit, even though I had this level and this level and this level as a potential level it could reach down to. I want to be getting out in the movement that was favorable for me. I don't always get the actual low of the day. I don't care to know that. Well, I shouldn't say it like that. I do care to know it. And how do we know it? We have a low here of 131.95. Okay, 131.95. What's 10 pips below that? 31.85, right? No, I'm not going to be able to pull it up on that because it's a 5-minute chart. Well, 31.83.7 was the level that the standard deviations for intraday volatility called for. So basically, it went, what, 11, 12 pips almost below that low. And you blend those things together. Where's my 15-minute time frame? You blend those things together, okay, to forecast a move. I want to get out before that. So I'm getting out before it runs down there because I may not get that exit. The broker may not let me get filled. It may not trade down there for my limit order. It may not get that far in my brokerage account. So I want to be getting out at that low-hanging fruit objective, rejection block. Look, man, if this doesn't give you, here's a 1-minute chart. This is one of the things I do like about MT5 is that on MT4, you can manipulate the things and make it look like you did a trade and you didn't really. You can't really do that I can tell with MT5. And you watch me do the video, I recorded the whole thing, kept showing you the time, pop it up in here like this and showing you as it was doing everything. And I immediately made the video as soon as I put some music over top of it and put it on Twitter. There's no way anyone can do Photoshop, okay, all this stuff, okay, that quick and then throw it on Twitter, which is again time stamped. So Everything in here, everything, even on a 1 minute chart, you can see the fair value gap in here that closes, trace right up into that mean threshold, the bearish breaker, sell it. Let me zoom in here. Again, I really want you to appreciate this. Look at the high of the candle. Like this is painted by MT5. Immediately as soon as you get in, it puts a little red arrow in if you're going short, and a blue arrow when you buy, if you go long, or if you take partials. I bought something out here, 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 and then finally down here, below the rejection block. It trades down a little bit more, not by much, but then look where we're at now. Well, it's better if I show you in a 15-minute time frame. Then the fundamentals kick back in. Down here, when I covered my short, boom, rallied up. What's it doing? Buy side liquidity pool, and we have another buy side liquidity pool that is yet to be cleared out, but I think that's going to be the next one that we reach for. But relative equal highs. So everything in here is taught in the core content. I didn't see this set up. I'm doing 1,000 things all day long. I'm being myself, not just ICT too. I mean, I want to have time with my kids. They're out of school. I'm doing all those things. I'm jamming that inside of a 24-hour block of time. And it pisses me off, frankly, when I see people in the forum say, I shouldn't be on Twitter. I should be spending more time in the videos, teaching and explaining things in videos. I have done thousands of hours of videos, okay? I want you to stop posting things in my forum saying I should spend more time making videos, and you should be more time spending in studying my videos, because none of you have mastered it. Everything that I've taught, none of you have mastered that. So when one of you can come forward and say you've mastered that, that's the person that can run his mouth and say, or her mouth, and say that I need to be spending more time, because I have given you 1,000 hours worth of things, and none of you have mastered that yet. So please, remember whose house this is. You're guests here. Even though you've paid, you're still guests. And I invite you every single day, because you paid for your seat, to be a part of my life every single day. And I break down things that I feel are important at the time in the marketplace for your learning and your edification. Don't be offensive. You don't find this type of stuff anywhere else. And I give you far more time than any other educator would. And believe me, you didn't pay enough as far as I'm concerned. But I saw it hit this level. It was consequent encroachment of the fair value gap. Beautiful, beautiful overlap. And then my mind said, okay, well, it's going to be an expansion on the downside, reaching for liquidity. So where's the liquidity at? Asian range lows, liquidity pool, liquidity pool, liquidity pool. So as it trades down, I don't know if it's going to go down and hit those. You see me adjust my stop in the recording I posted on Twitter. The stop is there to do its job. But if the market allows the reprice to these levels, I'm going to do what? Pay myself. That's not guessing, Mike. Okay? These things overlap perfectly. Okay? I'm not form-fitting anything. I'm using the stuff that I teach. And if that's really how you feel about it, or anyone else feels that way, honestly, get the hell out of here. Okay? Because I don't have time for that. I don't have time for it. You can go over on social medias and talk all the stuff you want. Go on Forex, Peace Army, and blow smoke up their rear end and tell them what you think, okay? Because I have thousands of people in here, okay, that don't see it like you. And this is tough love. Whether you think this is professional or not, I don't care. Because the way you act is a problem. You need to fix that. It's not a problem for me. Because obviously I can do whatever I want to do in the marketplace and it's done. But it's a problem for you because you're thinking very toxic. And as some of you that are quiet, maybe you think the same. Maybe you have the same tendencies. I know there's one other person, there's another Mike, Trader Mike, I think it's his name in the forum. Very opinionated about how I conduct myself on a personal level. I am allowed to do whatever I want to do. Okay, I earned that right. I have the freedom to do whatever I want to do, say whatever I want to say, and I don't care who likes it or doesn't agree to it. Period. You don't have to like me as a person. You didn't pay me to be your best friend, and we're going to be on the same level in every aspect of life. And how I spend my time outside this mentorship is none of your business. None of your business. If I want to spend my time helping people that don't have the money to be here, I love teaching regardless. But if I'm going to be on social media doing anything I want to do, it's because I'm passionate about doing it. I know there's thousands of people that will never, ever, 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 ever pay me to join this mentorship. I still enjoy sharing and reminding them that the stuff that I've already produced for free is beneficial to them, because I still am encouraged. I'm stirred up because of their feedback, and they're inspired. And that is something that I live on. That's the fuel. Okay. I don't feel that, okay, in the mentorship, because you're all busy doing what you're doing and studying. But I tap into the social media crew because I get to relive that moment of astonishment. Now, I'm not saying that your emails that come to me by way of the mentorship group, telling me that you've had epiphanies, that you've had leaps and bounds understanding come to you because of the lessons. I appreciate that. But I'm saying from a volume basis, in other words, I get a lot of feedback from new people that have never seen these things before. They've never seen it before. And they don't sit down with me on a weekly basis and hear what I'm telling you what's going to happen before it happens. They're doing whatever they're doing in their own studies. And I remember what that was like. And then I take that energy and I pour right into you. Because look at YouTube. Do you see me making videos over there? No. It was months. I think it was February of this same year, the last video I put on there. It really wasn't all that big of a deal. And the recent video wasn't even a trading video. It was about how your mindset about social media, utilizing social media. That same energy, I take that and pour it right into you. So again, it's very easy to get wrapped up in your own personal life and forget that I'm a real person. Okay, I'm easily offended when it comes to things like this. I'm not a snowflake, but I am very, very passionate about my time, because I think, honestly, I give way too much time. I pour way too much time into this. And even though it's made me millions of dollars, I've had money before this mentorship. And if I didn't love what I was doing, believe me, I wouldn't be doing it. And I don't want people trying to turn this into baby pits, because frankly, I'll throw your ass right out of here. I've already done it with a couple people already. Believe me, you will not be in here sowing discord. And you can say whatever you want to say on social media. Talk about anything you want to talk about, okay? But you won't do it in here. I won't have it. Everybody's welcome to, give their opinion about what they think of me and what I'm able to do in the mentorship. It's open book. I tell everybody. If I don't know what I'm talking about, you tell everybody, okay? But don't blow smoke up their rear ends, okay, and talk about how it's guessing, because this is not guessing. And that's all I got to say.